Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 19th, 2018. It's a little after 3, so we have about an hour to go before the markets close. This is my third video for the day, second regarding the markets. And keep in mind, that's a function of the frequency of my market updates as well as the trade ideas thrown out in the last week, quite a bit, a few new, several new trade ideas on the site for members and increased market analysis. And that's a function of the increased volatility. As I say, traders make money when there's volatility. Buy and hold investors, the last few years was great for those in 401ks. In fact, it was an unprecedented period. We've never seen in history such an extended period of low volatility at such extreme low levels for such a period of time. And they refer to that as the short vol trade. You can Google that term, short VOL. And just about everyone that studies the financial markets, including myself, agrees that the short vol trade is not only busted but gone for good. We probably won't see that again in possibly in our lifetimes, at least not for a very long time, which is a great thing for active traders, trend traders, and I don't think it's anything to be feared for long-term investors. I do both, so I'll cover, in other videos, I'll cover what I'm doing with my long-term accounts and things like that, 401k money. There's plenty of money to be made in bear markets, both on the long and short side at different times with different asset classes. So let's just dive into the charts here. I'll do this update and wrap it up quick. What's happened today? So let's see. We're down big. The Qs are down as I do this 2.76% with the SPY down 1.74. We're looking at SPY here, the S&P 500 tracking ETF on a 60-minute chart. We're still a little below, but flirting with this 269.90 level. In other words, we broke it, but these are 60-minute candles. You can see we're well below and we snapped back up, closed right on it. Well below, we snap back up, close just, on it on the underside, 269, whatever, 90. And we're not too far below it now. So the markets are pretty stretched. Here's what I would tell you. If you didn't already short on the breaks of these trend lines or short when the Qs failed that break out the new highs, um, it's not very objective to short here. First of all, we're at support. This is also what I call no man's land. We're now between support and resistance. Um, the next targets are, I don't have them here. We're going to jump out to the daily charts because as I told you guys over the last few months, I've been living in the world primarily, living in the world of the 60-minute charts because there weren't many significant technical developments to mention or cover on the daily and weekly timeframes. However, those are the more important, more significant timeframes. What I mean by that is if you get a trend line break or a bullish or a bearish chart pattern breakout on the 60-minute chart, well, that's usually good for a trade that can last a few days to a few weeks, maybe a little over a month, 5, 6 weeks. However, you go out to a daily chart and you break a trend line, a well-defined uptrend line that goes for years, 1, 2, 3 years. That is a much more technically significant sell signal that has longer-term implications that can start a new trend that can last for many weeks or months or more. And especially the weekly charts. So we're going to do that now. I'm starting to turn my focus. I just wanted to follow up because I've been covering these 60-minute charts. There's SPY. Great if you're short. We're really overstretched. I don't see anything in the charts. I have to say right now, I looked at the 15-minute charts. I don't see anything compelling that says we're going to have a meaningful bounce, but we are very oversold near term. So hard to say what we're going to do. Maybe another thrust down. It wouldn't surprise me to see as much as we're down today, we could thrust down into the close. The Qs seem to be, consolidating, almost flagging here. Not really a perfect bear flag, but you can see the sharp move down, this consolidation period action, or I should say, right below that 166.80-ish support level I had at target. And these are the next targets down here. And I mentioned this is we're probably going to see that 163 level before all is said and done. What I mean by before all is said and done, talking any counter trend bounces aside. So let's just say, maybe another dump today, another bounce up, and then come down and hit that. And this is where I'd be interested in covering, any QQQ shorts that I have right now or derivatives, anything of that nature, and maybe looking to go for a bounce. But we also have to look at what's going on with the 60-minute charts. I'm sorry, the daily charts. Here's QQQ. This is the big picture. again, this is where you get the bigger swing trades. This is a powerful divergent high. Um, And this is a scenario I laid out back here when we were testing these long-term trend lines of the markets going on to make a new divergent high, a new high, which would be a divergent high. I outlined in advance, and that happened, but it happened with QQQ, not SPY. The Dow, the SPY, those are full of dividend-paying stocks. They're rate sensitive. They didn't really rally up as much as the tech stocks. Everybody jumped back into the beloved FANG stocks, Facebook, Apple, Amazon, Microsoft, and Alphabet, and that's what rallied the Qs up. But I'll take it. This is again, this has been the leading index from since the lows in March of 2009. This is where everyone's gone. They want to own tech. They want to own those big names. Um, the world's largest companies, which are all the top components of the Nasdaq 100, and many of which, of course, also top components of the S&P 500. But again, the S&P 500 was weighted down with utility stocks and dividend-paying blue chips, all different other types of companies. So that's that. And where I'm going with this is now I'm starting to focus on this daily chart and this divergence playing out. We now have confirmed negative divergence. See that bearish crossover, unless barring a big stick save into the close today, meaning a reversal, maybe backfilling that gap, and I absolutely do not see that happening. We're going to have this bearish crossover confirmed here. That is big negative divergence. This portends more downside in the coming days to weeks. So, what we do tomorrow, what we do today into the close, anybody's guess, but I have no desire to be shaking out any short positions at this point. In fact, we added some more short exposure on the site today, and this 162.40 looks like the next target to me here. And I think before all is said and done, at the very least, we come down here to test this trend line. Now, this trend line, I have two intersecting trend lines. Let me show you this. These are what I'm watching. And again, I'm putting more and more of my focus right now on the long-term charts. So this is what I refer to as a minor uptrend line that comes off the lows here in, looks like March of 2017. And then this longer, more significant trend line. This goes back to the left of the chart. In fact, this is the same trend line I have on the weekly chart. We'll get to that in a second. You'll see it. So from where we go from here, minor zigs and zags, squiggles aside, I think we come down to that level. I also have support there about 156.40 that comes in. And that's where we'll probably have at least a reaction, a bounce or something like that. Especially if the Qs can't manage in the very near term to turn around. I still maintain what I said this morning in today's video that I did before the open. If we get a kickback rally to backtest the top of that gap, that's a great shorting op. That's very objective. Let's look at it on the 60-minute chart. There's that gap. This is just beautiful technical analysis. We had that breakout to new highs. Let me try to find the right tool here. Ellipse, there we go. We had a breakout to new highs. This was a divergent high, another divergent high with a correction, double top high, and then we gapped above it. And we tested it all week from Wednesday to Friday, and finally, boom. And this is what the market does. And in a way, I might talk like a geek because I love the market so much. This is the nature of the market. It's like a beast. Just like it gapped up here to leave people behind that were waiting for breakout of new highs, it gapped down below. It kept these people, whoever bought the pullback, said, okay, you know what? We broke out the new highs. We'll come back, make a back test. So the 170.88 level, that was these two previous highs and that gap. So I'll go long here with a stop below. Well, they got a pretty big wake up call today. We gapped down, and at that point in their head, I'm just trying to think like other investors and traders might think, okay, we gapped down, and of course in the morning it didn't look as ugly as it did now. So they're saying, oh well, okay, that level gave way. We broke down. It's a failed breakout, so I'm going to get out, but I'll wait for a kickback rally. Well, no, the market doesn't make it that easy on you. It trapped those people in, and it just gave them more pain and more pain and more pain. And when you get that, I'm telling you, I've seen this time and time again. It's very bearish. This is what they call a bear trap. I'm sorry, a bull trap. Break out to new highs. By definition, you read up on TA, breakouts to new highs on face value are bullish. But as I often say, fewer things in trading or technical analysis are more bearish than a failed breakout. Works both ways. In this case, it was an upside breakout, so it's bearish. False breakouts to the downside are bullish. So that's it. And again, if we happen to get a kickback rally, Uh, the next two objective levels to add would either be the bottom of the gap or the top of the gap. Those are both resistance levels. I can't promise you they'll work if we get it, and I can't even promise you we'll get that. But if you do, I can promise you this. In my opinion, it's a very objective level to add, that 170.88-ish level. I wouldn't wait for 170.88. I would short before it. If you're not already short, or if you are and you wanted to add more short exposure, and swing that down to that level, that 163-ish level, which comes in roughly here. I had said 162.40 on this, so you might want to cover a little above that. Call it 163. That's another thing in trading. If I see two support levels, one's 163 and the other's at 162.40, and they're both towards the end of what I expect on a pullback, I'll cover it the first of the two unless I have a strong reason to suspect we're going to go a lot lower. So there's QQQ. This is the weekly chart. Let's just 10-year weekly chart. Here's that trend line. And again, this is the trend line on the daily chart. It comes back to the 2015 lows. A lot of reactions on it. There was that break, that sell-off in January. We had the intra-week break, but as I said before it even happened, you got to wait to see a weekly close below, and I didn't expect it, and we got it as expected. We closed back above there. Same with the SPY. We closed back above trend. So QQQ has a little room. This is what I'm trying to say, and you got to give it the benefit of the doubt. We're in a bull market, one of the strongest bull markets in history. So as far as long-term sell signals, if you're listening to this and you have a ton of money in your 401k and you can't short, and you've been riding this wave, and you've heard for years everyone telling you, oh, the bear market's coming, bear market's coming. Well, you might want to wait for this to go as well as this trend line on the SPY. Now the SPY is challenging that trend line now once again, and this is worrisome if you're long, because we've had now 1, 2, 3, 4, 5 candlesticks, 5 tests in the last 7 weeks of that trend line. This one had a stick save. You can see we closed back above it. Normally, in a healthy bull market, when you hit a trend line, you hit that trend line and then boom, back off to the races. That's what happens in a heavy bull trend. Hit the trend line, off to the races. And the rallies are pretty powerful. This one was close. But what happens towards the end of an extended trend, here's a trend line here, just to show you again. Boom, here's trend line tag, big rally, trend line tag, big rally, trend line tag. But you can see towards the end of a trend, the vigor of the rally diminishes. You don't rally as long or as high as you did off those earlier tags. And what happens if we really zoom in close, you can see here, boom, 1, 2, 3, 4, 5, 6, and then we close below 7 weeks, and then boom, it gave way. So the fact that we've been testing really increases the odds this trend line can go soon. It's showing you that the market, my take on this, it doesn't have the demand, the appetite for the voracious demand for buyers to step in as it did before. So the supply demand dynamics are shifting, but we haven't broken that yet. As I like to say, support is support until unless broken. And looking at the weekly charts, you guys will recall, if you followed me back here when we were dropping off, we had sell signals right here shortly after the highs, and I started getting bullish here, and I laid out a scenario at the time on the daily charts for the markets to go on to make new highs. Now I got one of the two right. As I said, the QQQs made new highs. SPY didn't. SPY fell short of the highs, but the QQQ has been the leading index, and 1 out of 2, if for that fact, it's good enough. We may have seen the highs. However, here's what I'm leaning towards now. As much as I say we're dancing right now with some key supports, we're on a very precarious technical level. I still think this market will probably go on to see new highs before it breaks down. I wouldn't bet the farm on it, but on this weekly chart, it looks a lot like that same scenario I laid out before on the daily chart, and we did get it with QQQ. And what that is one more thrust up to take out the previous highs, get bullishness just going crazy, and then get the big move down, the big breakout, a bigger drop, because if we take out new highs and we retest these lows, that will be obviously a larger correction because we'd start from higher levels. And what it would do, it would put in some divergences, negative divergence on the weekly time frame. These are bear market things. If you get negative divergence on the on the weekly time frames, Those are trend changes that can last many months and are usually measured well into the double digits. So I'm looking at maybe at some point this year, and I don't know if it comes now. And I'm open to that. It's the possibility. I can see this is a pretty important support level. This is that same weekly trend line, 268.55, and there's a thin zone between. You might not see what I'm saying. This trading was swift and very fast. This break below 268, 268.55. Let me show you something here. The volume at price, I have that muted down. See these volume at price bars here I just turned up? This is what I call a thin zone right here, this area here. So if we get much below there, and you can see there's good support, this is where QQQ is probably, I'm sorry, SPY is probably headed 248, 248.27. So watch this trend line, but also remember if we give way here, there's still some support, a little bit of support below from these recent lows, and you still have the Qs clinging to support now. So uh, time to not get too aggressive unless you're quick and nimble and you can reverse if the market goes against you. Let's turn those volume at price bars back down. I like them a little muted so my chart's not too busy. And QQQ, there's that divergent high I talked about, the new high, and so far it's been an impulsive move down, confirmed divergence, everything else. So I'll wrap it up here, and I can only tell you what I'm doing. I'm willing to ride out, and I expect, at some point kickback rally. I don't think the market's, there's any reason for a big meltdown right now. But as I did say a few weeks ago, that if we started to move lower, the selling would probably start to increase and become more impulsive. So we're very oversold today. Rarely do you see the QQQ drop more than 3%. We were down 3% at one point today, either a little under, a little below, and we're kicking back right now. But this is flagging type action too. So um, you know, it wouldn't surprise me. See, this is what I'm referring to: a flagpole, it's bear flag type action. So I think in the next day or two, I think this week, by the end of the week, we hit 163. Let's just keep it simple like that. If we happen to kick back higher, I have a little room to add, and I'd probably add on there at the bottom of the gap or at the top of the gap, like I mentioned, for a swing down. Anything else, like I say, the charts are dynamic, and so is my analysis. So if something changes, I'll try to, quickly adjust my analysis and get my thoughts out to you. But that's it. So not the most objective time to add to shorts if you haven't already, but you may get a kickback rally to add to a position or initiate a new one. But I don't think it's time yet. I don't see enough evidence to go long and step in and buy this dip yet, even if this market is going to new highs before we go much lower. I would rather wait to see QQQ come down to 163, and I'd like to see some divergence at least on the 15-minute time frame. I mean, we don't even have divergence on the 5-minute time frame. So near-term bias, I have to say, for me, other than super near term, the next hour into the close or anything, my near term bias remains to the downside right now. Good luck, stay safe, and if you guys have any questions, members of the site, I'll be in the trading room, and I'll try to get back to you on any questions or chart opinions as quick as I can. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed.